Assalamualaikum, we are from grade 8 and today we will be presenting about analysis of financial statement between Hartalega and Top Glove Corporation Berhad. Hartalega Holding Berhad was established in 1988 and is a public limited investment holding company. Hartalega Holding Berhad is manufacturing of medical and industrial gloves such as latex gloves, suppliers such as healthcare, dental, food, industrial and spa and beauty industry. While Top Glove Corporation Berhad was established in 1991 and is a public limited company. Top Glove Corporation Berhad is a rubber product manufacturing such as rubber glove, nitrile, latex and vinyl and surgical. There are also non-glove products such as face mask, dental dams, exercise band, latex sheets.
I will present three important financial ratios. First is current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay its short-term liabilities using its current asset. A higher ratio means stronger liquidity and short-term financial health. As you can see in the graph, Hartalega current ratio improved from 3.91 in 2022 to a peak of 6.67 in 2023, before slightly dropping to 5.92 in 2024. In comparison, Top Glove had a current ratio of only 1.93 in 2024. This means Hartalega has nearly 6 times more current assets than liabilities, showing it is in a much stronger position to cover short-term debt than Top Glove. However, it is so important to note that an extremely high current ratio can indicate inefficiency in using assets, for example, holding too much cash or unused inventory. Second is quiet ratio. The quiet ratio, also called the asset test ratio, is similar to the current ratio but excludes inventory. This gives us a clearer picture of a company's ability to pay short-term liabilities with its most liquid assets like cash and receivables. Hartalega's quick ratio was 3.42 in 2022, increased to 6.01 in 2023, and slightly decreased to 4.92 in 2024. In contrast, Top Glove quick ratio was much lower at 1.53 in 2024. It shows that Hartalega not only has strong liquidity, but it can cover its short-term debt even without selling inventory, which reflects a more stable and conservative financial position. Third is inventory turnover ratio. Inventory turnover measures how many times a company sells and repairs its inventory in a year. A higher turnover means inventory is sold quickly, which usually indicates good sales performance and efficient inventory management. Hartalega inventory turnover dropped significantly from 19.87 in 2022 to 10.37 in 2023 and further down to 4.77 in 2024. Meanwhile, Top Glove had a higher inventory turnover of 6.64 in 2024. This shows that Top Glove is more efficient in managing its inventory. Hartalega declining turnover could mean slower sale or excess inventory, which may lead to higher storage costs or product obsolescence.
Next, for fixed asset turnover ratio. This ratio measures how efficiently a company uses its fixed assets to generate sales. If we look at the chart, Hartalega's fixed asset turnover was 2.5 in 2022, showing its strong efficiency compared to 2023 with only 0.82 and slightly lower to 0.81 in 2024. So when we compare to Top Glove in 2024, Top Glove only recorded 0.69, which is lower than Hartalega. But although Hartalega was slightly higher, both companies showed weak performance in managing their fixed assets. For total asset turnover ratio, this ratio shows how well a company utilizes all of its assets to generate revenue. If we refer to the chart, Hartalega's total asset turnover shows a downward trend from 1.24 in 2022 to 0.45 in 2023 and then to 0.35 in 2024. Top Glove's 2024 ratio was 0.36, which is slightly better than Hartalega. This suggests that in 2024, both companies were struggling to generate revenue from their total asset. Lastly, days sales outstanding. This indicates the average number of days a company takes to collect payments from its customers. Looking at the chart, Hartalega collected payments was 20 days in 2022, and this increased to 49 days in 2023 and 77 days in 2024. When we compare in 2024, Top Glove took 50 days, which is shorter than Hartalega. It shows that Top Glove had better control over receivables during that year compared to Hartalega. Lastly, days sales outstanding. This indicates the average number of days a company takes to collect payments.
Moving forward to debt management ratios. The first one, debt to capital ratio. This ratio shows the proportion of a company's total capital that is financed by debt. It measures how much a company relies on borrowing to fund its operations and assets. Hartalega had 18.95% of its assets funded by debt in 2022, and the ratio dropped to 12.90% in 2023. In 2024, Hartalega recorded a debt ratio of 11.67%, indicating that only a small portion of its assets was financed through debt. Top Glove ratio was higher at 16.14%. Both were still within acceptable financial limits, but Hartalega showed a more conservative use of debt and lower financial risk. Next, times interest earned ratio. This shows a company's ability to meet its interest obligations on outstanding debt. Hartalega shows strong profitability in 2022, with the ability to pay its interest expenses 972.28 times. This changed drastically in 2023, when the company reported a loss and was unable to meet its interest obligations, leading to a negative ratio of negative 27.27. In 2024, the situation improved as Hartalega recorded a tie ratio of 6.03, showing it could cover interest costs 6 times over. Meanwhile, Top Glove ratio stood lower at 3.15, indicating that Hartalega had better financial strength and was less risky for lenders and investors.
So now I will briefly explain about the profitability ratios. Okay, first is operating margin. This ratio measures how efficiently a company generates profit from its revenue after covering operating expenses. Which is what we can see from the chart. Hartalega made a big profit in 2022, which is 58.84%, but suffered a loss in 2023 and falls to negative 8.58%. In 2024, it started to recover with a small profit, which is 2.52%. And Top Glove in 2024, it still made a loss, which is negative 0.01%, meaning it could not cover its operating costs. So the conclusion is Hartalega managed its costs better and performs stronger than Top Glove in operations. The second one is profit margin, which is this ratio show how much profit a company makes for every RM1 ringgit of revenue. It shows how much net profit company makes for each RM1 ringgit of sales after all costs are deducted. From the chart, we can see that Hartalega made a big profit in 2022, which is for 1.10%, but suffered a loss in 2023 and fall into negative 9.91%. In 2024, it made a small profit, which is he gained a profit 1.07%. And Top Glove had a very small loss in 2024, which is negative 0.009%, meaning no real profit from sales. So the conclusion is Hartalega is better at controlling total costs and is less risky than Top Glove.
Okay, so next we go to the basic earning power, BEP, which is we can see from the graph, which is Hartalega was record a positive BEP of 0.88% in 2024 and still able to generate operating income from asset use. For the Top Glove, there's still negative, which is negative 0.04% of basic earning power, which is this is reflecting operating loss and less efficient asset utilization. Okay, next for the fourth one is return on asset, which is ROA. From the graph, you can see that the return on asset of Hartalega is 0.38% in 2024, which is this shows the ability to generate profit from each asset even in recovery. And for the Top Glove, there's still negative return on assets, which is negative 0.89%, and this is a poor performance in generating returns from company-owned asset.
Return on equity. This ratio shows how efficiently a company uses its shareholders' equity to generate net profit. In terms of ROE, Hartalega experienced a sharp decline from a strong 62% in 2022 to negative 5% in 2023, reflecting a significant downturn in profitability and shareholder value. However, the company showed signs of a slow recovery in 2024, recording a positive ROE of 1%. In contrast, Top Glove reported a negative ROE of negative 1% in 2024, indicating continued losses and poor returns on shareholders' equity. Moving on to the market value. The first one is price per share. This figure shows how the market's valuation of a single unit of the company's stock, reflecting investor expectations and company performance. Hartalega's PE ratio rose sharply from 5.13 in 2022 to negative 27.62 in 2023 due to losses, before surging to 743.23 in 2024. In comparison, Top Glove's PE stood even higher at 1,100 in 2024. This means investors are paying more for every 1 ringgit of profit made by Top Glove compared to Hartalega. Next, the market ratio. This ratio shows how the market perceives a company's value relative to its financial performance, helping investors assess whether a stock is overvalued or undervalued. Hartalega's market ratio declined from 3.34 in 2022 to 1.40 in 2023, indicating a drop in market confidence or valuation. However, it rose to 2.02 in 2024, showing a slight recovery and improved investor sentiment. In 2024, Hartalega's market ratio 2.02 was higher than Top Glove's, suggesting that investors value Hartalega more per unit of its net assets. This indicates stronger market confidence in Hartalega compared to Top Glove.
The point equation. Hartalega ROE dropped from 63.195% in 2022 to negative 0.051% in 2023 and increased to 0.0043% in 2024, reflecting reduced efficiency in generating profits and maintaining shareholder value. Using the DuPont analysis, the decline is due to lower profit margins, reduced asset turnover, or lower equity multiplier. Hartalega 0.0043%, DuPont ROE is higher than Top Glove, negative 0.0046%, indicating stronger profitability and asset utilization. Top Glove should improve efficiency and asset use to boost ROE. Conclusion and recommendation to improve company performance. First, Hartalega Holding Berhad shows strong financial performance with a high liquidity ratio. However, the declining profit margin in recent years need attention to ensure sustainable growth. Second, among the proposed improvement measures include reducing operating costs, introducing new product, and exploring market in the healthcare sector to increase income and reduce dependence on one type of product. The third one, the company also needs to strengthen its long-term strategy by intensifying global marketing effort, continuously monitoring financial ratio, and managing assets and liability efficiently to remain competitive in a challenging industry.